So, have you ever seen a startup with just a handful of people and a cool idea get valued at millions or even billions of dollars and thought, how? I mean, how do you put a price tag on something that's really just a dream with a business plan? Well, that's exactly the puzzle we're going to piece together today. Let's just jump right in with the core issue. What's the single biggest hurdle here? I mean, you've got a team that might be amazing or might not work out, a market that could be huge or could disappear tomorrow, and usually there are no profits, maybe not even any sales. It all boils down to one massive thing: uncertainty. And that's what we're here to talk about. All right, so to cut through all that uncertainty, investors don't just throw a dart at a board. There's actually a formal process. So before we get into the cool methods they use, we need to understand exactly what we're talking about when we say we're valuing a business. And at the center of it all is this: business valuation. This isn't just a hunch or a quick guess. It's a super detailed process of figuring out the economic value of a company. You're looking at everything: the team, the tech, the market, you name it, to figure out what it's truly worth. It's used for all sorts of things, but for us, it's all about that big moment: getting investment. Okay, really quick, let's clear something up. You'll hear two words get thrown around: evaluation and valuation. They sound similar, but they're worlds apart. An evaluation, that's like a quick gut check, an informal opinion. But a valuation, oh, that's the real deal. We're talking a formal deep dive report with all the paperwork to back it up. That's what gets an investor's attention. So how do you even start this process? Well, first things first, you've got to get your head in the right space. And the biggest mental shift you have to make is this: stop hunting for one single magic number. It's not about that. It's about thinking in terms of a range. And that range is built on thinking about three different futures. You've got the pessimistic view, what happens if things go wrong. Then there's the realistic case, where the company pretty much hits its goals. And then you've got the optimistic case, where it just absolutely crushes it and outperforms everyone's wildest dreams. A solid valuation has to consider all three. Okay, mindset is locked in. Now let's open up the investor's toolbox. We're going to look at the actual tools that founders and VCs use to start putting some numbers on the table. And here are 5 of the big ones. Each one of these is like a different lens for looking at the same problem. They all have their strengths, and we're going to take a closer look at a few of them to really get how this all works. All right, time to get our hands dirty. As we dig into these tools, you're going to see something really interesting emerge. Valuing a startup isn't just one thing. It's this incredible blend of art and science. Let's start with the art. This is the Burkes method. It's pretty much perfect for those super early stage companies. We're talking pre-revenue, sometimes even pre-product. It's basically just a great idea and a solid team. This is a huge favorite for angel investors. So how does it work? It's beautifully simple. An investor looks at these 5 key areas and assigns a value to each one, often up to $500,000 apiece. See, there are no complex spreadsheets here. It's all about making a judgment call on the quality of the idea, whether there's a prototype, and maybe most importantly, how good the team is. Okay, now let's do a complete 180 and go from the art to the science. This is the discounted cash flow method, or DCF for short. If you've ever taken a finance class, this one will probably look familiar. The whole idea here is purely mathematical. You start by trying to predict all the money the company is going to make over the next, say, 5 or 10 years. Then, and this is the key part, you apply something called a discount rate. That's just a fancy way of saying that money in the future is worth less than money today, especially when there's a ton of risk. Once you've done that, you add it all up to find out what all those future earnings are worth right now. It's an attempt to get a super precise answer. But here's the big problem. For a startup that's just getting off the ground, trying to predict its cash flow 5 years from now, it's basically fortune telling. The science is only as good as the guesses you put into it, and for a startup, those guesses are really, really hard to make. So what if you could take that art of thinking about different futures and blend it with the science of a financial model? Well, that's where the First Chicago method comes in. It's a really cool hybrid approach. Remember those 3 scenarios we talked about? Best case, base case, and worst case? This method runs a full valuation for each of them. Then you take a guess at the probability of each one actually happening. You multiply it all out, and you get a single, weighted average valuation that already has all that uncertainty baked right into it. Pretty clever, right? And to finish filling up our toolbox, here are two more heavy hitters. The venture capital method is all about the exit. An investor says, okay, I need to make 10 times my money on this. If I think it can sell for $1 billion in 7 years, what does it need to be worth today? You literally work backward. Then you have comparable analysis, which is about looking around you. You value a startup by checking out what similar, more mature companies are worth in the public market or what they've sold for. So, we've looked at all these methods, all these scenarios, all this art and science. But how do you get from all of that to the one number that ends up in the headlines? How does it actually happen? And honestly, this is the most important thing to understand. A startup's valuation isn't just spit out by a spreadsheet. It's a negotiation. It's a story. The founder tells a powerful, compelling story about the future they're going to build. All those methods we just talked about, they're the evidence. They're the data points you use to make that story believable. The final number is the middle ground where the founder's vision and the investor's conviction finally meet. So, at the end of the day, a valuation is so much more than just a number. It's a narrative about what's possible. It's a bet on a team and their ability to turn an idea into reality. It's a story about the future, just backed up with some analysis. And that really just leaves us with one final question to think about. What story is your idea worth?